Welcome to the Stock Market Palantir. Today we are going to talk about GAME. Welcome to the debate. Today we're looking at GameSquare Holdings, Inc., and honestly, it presents one of the most intellectually challenging valuation puzzles we've seen in the microcap space this whole quarter. Their Q3 2025 financial report, it painted a deeply confusing picture. You have a catastrophic business failure on one hand and a sudden, almost paradoxical profit on the other.
And that is precisely the core conflict, isn't it? How do we, as investors, responsibly value a company whose legacy business, we're talking esports, digital media, just completely collapsed with a massive revenue miss, yet somehow it managed to report positive net income? And that profit, it was generated entirely by a highly speculative digital asset treasury strategy. So the real question is, are we looking at a fundamentally failed media company or maybe a nascent, high-risk financial entity?
See, my position is that the market must start valuing the company based on this strategic pivot. Management looked at the dying media assets and, I think, acted decisively to generate capital where that legacy business just couldn't anymore. The new strategy is viable and, crucially, it is now profitable. That profitability should be what determines its future value.
I just come at it from a completely different way. The market's reaction, that really severe stock sell-off, was absolutely correct. The price is reflecting the fundamental, I'd say terminal failure of its core operational model. And, the enormous historical risk that's baked right in. The risk that comes from using highly volatile financial engineering just to mask that failure.
I can see why you'd think that if you're only focusing on the past, but let's look at the financial reality of the present. Management successfully delivered $5.9 million in net income from continuing operations for Q3 2025. I mean, this is a dramatic positive swing from the $3.9 million net loss just the year before. For a microcap that's fighting for its life, reporting millions in net income is an immense achievement. The source almost doesn't matter.
Well, it's a paper achievement, not an operational one. We have to be very precise here. That $5.9 million, it isn't operating cash flow. It's primarily a non-cash gain, most likely derived from a mark-to-market revaluation of their crypto portfolio.
It is still real capital generation, and it's derived from a deliberate strategy. The DAT was only launched in July of 2025, and management confirmed it produced over $600,000 of measurable earned yield in just the final 2 months of the quarter. That's yield generated through staking and lending protocols on Ethereum, which it demonstrates the pivot works. We even saw the market recognize this, at least for a moment, back in July when the stock jumped 60% and briefly secured its NASDAQ compliance. The market is capable of valuing it as an on-chain finance entity.
But that temporary jump means almost nothing when you weigh it against the definitive rejection after the actual Q3 report. We just cannot gloss over the fundamental mortality of the operational side. Revenues were $11.32 million. That is a 57.78% miss against expectations. A 57% year-over-year collapse. That isn't just a tough quarter. That is structural implosion.
I'd say that just demonstrates the inevitable decline of that whole legacy esports space. It confirms management's decision to get away from it was the right one.
No, it signals fundamental failure. It suggests that all those asset divestitures, like Complexity Gaming and the partial sale of Phase Media assets, that wasn't optimization like management spun it. That was a forced liquidation, and it leaves behind a hollowed-out corporate shell. Institutional sentiment backs me up here. Just look at the 47.44% off-exchange short volume ratio in dark pools. That is sophisticated money actively betting against the equity. So let's really focus on the sustainability of this DAT strategy versus the collapse of the core business. You're championing this $5.9 million paper profit, but how sustainable is yield that's derived from volatile crypto staking? It's non-recurring, and it's being used only to temporarily mask operational losses that haven't actually stopped.
So the market is, I think, rightfully rejecting the idea of a media company suddenly being valued as some unregulated microcap crypto fund.
But that's where the capital is being generated. You have to acknowledge that management successfully migrated capital away from what was a known massive money drain, operating these high-cost, underperforming esports teams, and moved it towards a strategy that is already generating measured yield, $600,000 in just 60 days. The failure of the legacy business necessitates focusing on where the actual value creation is happening right now.
$600,000 in yield is a drop in the bucket compared to a 57% revenue collapse year over year. You're using high-risk speculative income to cover a catastrophic, systemic failure.
And what about the divestitures? You call it liquidation, I call it opportunistic cashing out. I mean, the retail analysis often pointed to this content mill theory around the FaZe Clan acquisition, that the company was acquired primarily for its content library and IP, just to be stripped and leveraged. The subsequent divestitures of Complexity and FaZe Media assets, well, they validated that theory. It was a pragmatic, necessary move to secure the cash required for this data pivot, which is now paying dividends.
Pragmatic liquidation is still liquidation. The original business model is dead, and the public shell is now engaged solely in highly speculative financial activity, backed by assets they had to sell off.
Okay, well, that brings us neatly to the trading metrics. You highlighted the huge 47.44% off-exchange short volume, and I agree that's high. It is indicative of some institutional bearishness, but we have to scrutinize why they are shorting. The short interest as a percentage of flow is only 5.45%, and that is a crucial distinction.
Okay, explain why that gap matters to a regular investor who's just looking at the stock.
It matters because it means this isn't a traditional short position betting on imminent bankruptcy, not in the way we saw with names like GME. This activity is more characteristic of, say, high-frequency trading, HFT, or some advanced hedging strategies, likely related to convertible debt or other complex instruments. When you see such high short volume occurring overwhelmingly in dark pools, it tells you that institutions are actively trying to manage risk around the company, not necessarily trying to drive it into the ground. They think the stock is unstable, yes, but this doesn't confirm a universal institutional vote against the company's survival via its new profitable strategy.
I would frame that completely differently. The fact that 47.44% of the short volume is executed in dark pools, which for our listeners are sophisticated, non-public trading venues used by the big players, that indicates that smart money is methodically and quietly applying persistent selling pressure. They are not interested in some messy public squeeze. They are convinced the equity is fundamentally overvalued compared to its reality as a highly volatile investment vehicle with zero operational core.
And this leads us directly to the structural instability that keeps that smart money interested in shorting in the first place, the historical context of the NASDAQ compliance trap.
Exactly. We can't talk about valuation without talking about the repeated pattern of financial engineering. Since 2019, this company has executed 4 reverse stock splits, including 2 devastating 1-for-15 splits. The stock is currently trading at, 45 cents? It's non-compliant with the NASDAQ's $1 minimum bid requirement, placing it right back in the same familiar trap. The market is pricing in the high probability of a 5th reverse split. This history tells investors that management's default mechanism is to use equity mechanics to solve business problems, which is just a classic bearish feedback loop.
I'm not totally convinced that history is the primary driver here. While the history is, undeniable, framing every single reverse split as a sign of failure is a bit reductive. Some were necessary corporate actions tied to complex mergers and initial listing compliance, not just existential crises. But more importantly, let's remember the effectiveness of the pivot. The July 2025 announcement of the Ethereum yield strategy was the Hail Mary that brought the stock back into temporary compliance. It jumped the stock to $1.54.
Temporarily. It lasted barely 3 months.
It was temporary, I agree. The longevity is questionable. However, that event demonstrated that the market recognizes the DApp pivot as the only viable mechanism to maintain its listing status. The strategy isn't just about making some paper profit. It's about providing the necessary speculative excitement to maintain access to public markets. And that access itself adds tangible value to the public vehicle.
Survival at the cost of stability, leaving investors perpetually trapped in that cycle. So to summarize my position, while the digital asset treasury strategy can produce these temporary, highly volatile paper profits, the structural crisis, which is evidenced by the core business collapsing 57% and the persistent history of required reverse splits, It all means the company is correctly valued as a distressed asset fighting a desperate, expensive battle against delisting. The financial engineering risks, for me, they just overwhelm the promise of high-yield speculation.
And conversely, I conclude that the company, facing the inevitable decline of its legacy media model, has made a decisive and I think effective move toward a profitable, albeit high-risk financial future. The valuation conflict really just stems from the market's inability to reconcile the company's former identity as a media entity with its new reality as a financial vehicle. And that new reality is backed by $5.9 million in recent net income. Investors have to follow the capital.
So GameSquare Holdings remains a company defined by this internal war between its two financial identities. And investors are left to weigh the very clear operational decay against this speculative, yield-generating financial engineering.
It is a fascinating conflict. Truly one where the accounting structure is really dictating the entire narrative. We have discussed the core conflict in GameSquare Holdings' game valuation, analyzing the failure of its legacy media business versus the high-risk, paradoxical profitability generated by its digital asset treasury strategy, and the subsequent implications for institutional trading and NASDAQ compliance. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights and see you in the next video.